Recently, I read the book Beyond Bitcoin, Decentralized Finance and the End of Banks, and I decided to offer a review of the book. The book has two authors, Simon Dingle and Stephen Boykey Sidley, and it's interesting for various reasons. First, it offers a very good introduction into blockchain and cryptocurrencies. Next, it also discusses cryptocurrency regulation. And finally, there is a very good introduction into DeFi, that is to say, into decentralized finance. So if you're interested to know how decentralized finance works, what will be its future, and in general are interested in blockchain and decentralized finance, you can read the book or listen to this review. The book, of course, has an introduction, and from the very beginning it is outlined that the appearance of the new technology will revolutionize finance. Um, the book provides an example of the transaction between father and daughter who are in different countries. And the authors discuss the cryptocurrency transaction between those two individuals and its advantages, and then bank-to-bank transactions. Bank-to-bank transaction between those two individuals in the same countries. And so compared to the ambiguities and formalities that are related to ordinary banking, cryptocurrency transaction is evaluated as much faster, easy, and cheap to execute. It can be done without a middleman and without the government scrutiny, while all those can apply to ordinary banking. Of course, the banking experience can be way better than shown in the example, but the book argues that new financial technology certainly provides better experience. Actually, the book sees Bitcoin as an ancestor of DeFi, which managed to adapt to the changed circumstances and gave birth to various DeFi projects. And the cryptocurrency and blockchain are actually the foundation pillars of DeFi. One of the core pillars of DeFi is trustlessness, which means that it is not necessary to trust any human who is a system participant, controller, or creator. The technology is mathematically built in a manner that prevents manipulation. The book argues that decentralization and transparency make it possible to check the transactions and achieve the consensus that protects the system from unauthorized interference and ensures its immutability. Another issue is that the system is permissionless, which allows anyone to participate without revealing the personal information, while in traditional finance the identity shall be revealed, and also other information may be required. Also, the book doesn't forget to mention that not all blockchains are decentralized, permissionless, or trustless. It depends on their deployment strategy and manner. Then we move to Ethereum and smart contracts. And first thing that comes up is the explanation of public-private key cryptography, what it is and how it works. It is also emphasized that blockchain is cryptographically secured, therefore it is practically unhackable, and no one can move your tokens from your address without knowing your private key. The private key includes the numbers that are only known to you. Also, we have the explanation of Bitcoin. And it is emphasized that the major achievements of Bitcoin is that it resolved the problem of double spending. So people could no longer copy digital tokens and spend them at will, as every transaction is currently recorded by blockchain. It continues with the explanation of Ethereum, and we learn that main purpose of Ethereum is not only to be a peer-to-peer currency application like Bitcoin, but it also has a major other functionality, and it can run now smart contracts. Smart contracts mostly include financial applications on Ethereum blockchain, and those are kind of separate programs. So smart contracts include many if-then rules, which allow the coding of contract conditions into blockchain, and those can be set of rules, exceptions, inputs, and outputs, which finally result in different financial transactions. And contracts follow the blockchain rules, are transparent, immutable, and anyone can see the code and check the smart contract. The issue here is that, of course, blockchain is mathematically secured and more or less unhackable currently, but when it comes to smart contract, It is also unhackable if there is no problem in its programming language. But if there is kind of problem, if the programming is done badly and there is kind of bug included in programming, then a smart contract can be hacked. Now here in the introduction, there is no mentioning of it, but we will learn throughout the book that yes, smart contracts can be hacked. So finally, the idea that is developed by the book is that Bitcoin and Ethereum, with its smart contract feature, enable various individuals and companies to offer the new products in decentralized finance and revolutionize DeFi space. Also, there is a discussion of banking system, which we are not going to touch on at length, but we will mention that there is a criticism of current banking system as it charges very high transaction fees, and also its treatment of our money is not very clear. For example, when it comes to a crypto project, a DeFi project, Yearn, it is quite different compared to traditional banking. Yearn searches for the DeFi projects that require crypto capital and pay high interest rates. So you give your crypto capital to Yearn as deposit, and then it lends money to the DeFi project that offers the best deal, and then you get highest possible interest rate until Yearn finds a new project for a better deal. So the name of this new service is yield farming, and it doesn't matter how much money you deposit, the money of all depositors automatically and continuously moves to entity that provides the high returns, and all this happened in a transparent manner. While as usual, we don't know how banking works, and it's definitely unclear for ordinary users, and not all clients are equally treated in banking in a banking system, and the depositors don't get highest possible returns. So then we encounter a very interesting discussion of initial coin offering regulation. There are various regulations in the United States that aim to protect investors. So any entity willing to issue security shall publish prospectus that provides information on the company and its financial conditions, of course about assets and debts of the company. And the aim of such disclosure is to protect investors. So the ICO issuers did not want to be considered as securities issuers, because they would need to disclose their financial condition and the company's financial condition, which is a long procedure. Therefore, they asked for the legal advice. But the problem was that no one really knew what a cryptocurrency was. Was it a currency, a share, a collectible, a commodity, or property? And furthermore, all tokens residing on blockchain had different functionalities. Lawyers offered the application of the Howey test that was established by the Supreme Court decision in 1946 in SEC versus Howey. The Supreme Court offered a four-pronged test to determine the existence of the investment contract and the existence of security. The court said that if the transaction was an investment of money in a common enterprise with the expectation of profit solely from the efforts of management, then it should be considered as an investment contract and hence security. The discussion of crypto regulation continues with Ethereum's ICO. The Ethereum founders did not want to have an Ether that was a security token. They wanted Ether to have other functionality, so to argue that it was not only just a cryptocurrency but also an utility token. Okay, so when a user pays for transaction fees that are calculated in gas, it pays with Ether. Okay, so Ether has other functionality, and it is not only a cryptocurrency but also an utility token. Therefore, it is not a security. Okay, so Ethereum had a successful ICO. It was not prohibited by the United States officials. They did not argue that it was a security, and so ICOs proliferated. But the problem is that then DAO was launched on Ethereum blockchain. DAO is a decentralized autonomous organization, and it gives its members voting rights over financing other projects. Okay, so they're kind of investors who have rights. So it's a democratic organization, DAO, and it also issued DAO tokens to DAO participants who we are going to finance the projects. But the problem was that it was hacked. and which attracted the attention of SEC of the United States, and SEC said that DAO tokens were securities. Finally, it created different problems to ICOs, and ICOs were not as much actual and as many as before. As I said, I will discuss certain topics in a different manner, and these topics are related to decentralized finance projects. Those projects are MakerDAO, Compound, Yield Farming, and Yearn, decentralized exchanges like Uniswap and Nexus Mutual. After the most interesting part of the book that discusses various decentralized finance projects, we learn about scalability issues. Currently, we know that all transactions are validated by blockchain part nodes, and it takes time to achieve consensus as whole network shall come to terms. Now, another issue that different solutions came up to reduce the time for transaction validations, and the idea is that you reduce the number of nodes and increase the speed of and computing power of nodes. So you achieve speed at the expense of decentralization. There are also other projects, for example, Ethereum 2.0 update, which uses sharding. So sharding enables a database to be broken up into a subset of smaller databases, and with sharding, the transaction data is broken up into 64 shards and then sent to 64 child blockchains for processing. So not only transactional data is divided, but also blockchain power is divided for validating transactions, and in that way the speed is increased. Another mechanism is rollup. So transactions are bundled outside chain, for example outside Ethereum's blockchain, and validated by another blockchain, for example Polygon or Arbitrum, and then as a single transaction they go to Ethereum for validation, and in that way the speed is certainly improved. Then discussion continues with crypto derivatives that are in a developing phase. We also learn about NFTs, what they are capable of. Can they be traded or not on decentralized exchanges? Of course, they can be traded. Also, NFTs and metaverse, how NFTs and metaverse play out. Also, there is a discussion of games that use NFTs and game economy that uses NFTs like Axie Infinity. So we learned that NFT and DeFi projects have quite a perspective of cooperation, and it's possible to see new DeFi projects with NFTs. NFTs can participate with various DeFi schemes such as investing and borrowing. Then we continue about innovation, how DeFi is going to improve and increase, what are the risks, how state and traditional finance affect the improvement and development of DeFi, what are the problems. We also learned that digital asset regulation can be another issue, another problem. Also taxation. It's not clear what cryptocurrencies are. Are they currencies, commodities, property, or shares? So there is a conflict between innovators and regulators. So slowly we go to the conclusive part. In the conclusive part, there is a discussion of the history of banking, how it worked, what was its main standard, and it was a gold standard, but then it moved from the gold standard. Then we are talking about the role of the central bank. Central bank issued digital currencies as well as stable coins. We learned that China is testing its new stable coin, digital yuan. And finally, there is a chapter called the future, and in this chapter, the authors express regret about the lack of awareness of DeFi. They believe that it should be well known, as it is a very transformative product. And finally, they are sure that DeFi will certainly change the world of finance. Before discussing various DeFi projects, we need to understand that they are possible because of smart contracts and their functioning is based on smart contracts. The book opens the discussion of various DeFi projects by introducing stablecoin. So the idea behind a stablecoin is that it gets its value from something else. Like stablecoin Tether, briefly called USDT, is pegged to the US dollar and it costs $1. So one Tether costs $1, and it is supposed to be backed by the real US dollar reserves that are held in Tether's fiat treasury. So it is supposed that Tether saves the amount of dollars in its treasury that equal to the amount of issued USDT. So Tether is a fiat collateralized stablecoin. Another stablecoin DAI is not collateralized by fiat money. It is collateralized by other cryptocurrencies, and each DAI also is worth of $1. The issuers of stablecoin shall always ensure its price stability, and in our case, for example, one USDT shall always cost $1. Now, let us continue to the first 2DeFi project that was accomplished by Rune Christensen. He created a project, MakerDAO, which is a first DeFi project, as well as stablecoin DAI. So what MakerDAO does? It receives cryptocurrency deposits and then sends loans to the depositors in DAI. Okay, so you deposit your cryptocurrency, no matter what it is, and you'd receive DAI in return. So we know that DAI is a stable coin. It costs $1. So it's like receiving US dollars instead of depositing your cryptocurrency. But the idea is that cryptocurrency may get devalued. For example, Ethereum, when you deposit Ethereum, its price may decrease. So MakerDAO may get a huge loss. Therefore, Maker only gives you a loan in DAI that costs 66% of the deposited cryptocurrency. For example, if you deposit Ethereum that costs $100, you can only receive 66%, which will be 66 DAI, that is to say $66. So MakerDAO is a very successful and revolutionary project. It uses the first algorithmic-driven stablecoin DAI and is democratized. So the democratization is ensured by the governance token. So the governance token holders can decide the direction of the company, influence its management, and so forth. Therefore, MakerDAO is a very, very successful decentralized autonomous organization. Another interesting DeFi project is Compound, and it functions without a robust business model, so it's not that much profit oriented. And the major purpose of Compound is to build a scalable ecosystem. So it's a bit difficult to explain Compound without knowing what the liquidity pool is. The liquidity pool is the money that is immediately available for various activities. And the major purpose of the whole Compound system is to have liquidity pool always full, okay, full of money that is available, and they need to prevent it from emptying out. Okay, so you need to have it always full. Now, so the money is always available for different activities, for lending and borrowing and so forth, and the system founders need to always sustain the system stability and control the risk. So as we said, Compound is not that much profit oriented, and it doesn't profit from deposit and the lending rates, and its income is actually reinvested in a Compound pool to ensure the system stability, and also to add liquidity to the system. After discussing liquidity pool, the book introduces another interesting concept, liquidity mining. So the Compound requires contribution of funds to its pool, and in order to do that, it needs to attract investors, so to mine their pockets for ready capital. Okay, and of course, if you want to attract the investor funds, you can offer them advantageous interest rates. But liquidity mining has a different mechanism to attract the investors. So Compound rewards capital contributors for their participation. For example, in return for their deposits, they are rewarded by a new token. Okay, so you contribute a capital to the pool, and then you are rewarded by a new token. It is called a C token, which represents the principal amount and interest, and is itself tradable. So, for example, if you contribute DAI token to the pool, you will be rewarded with C DAI token, which includes the DAI you contributed plus capital. So if you want to withdraw your original DAI that you provided to the pool, you have to return the C token, and you will receive original token plus interest. C token can be sold and also can be invested in another product, and you can receive then better returns. Compound has another incentive for liquidity providers. It is Compound's governance token, which the liquidity providers receive in proportion to the deposited amount. Comp is openly traded on crypto markets, and it confers voting rights to the token holders and enables them to vote on the governance and future of Compound, and also they can decide on the C protocol changes. Just one remark here, I've called liquidity pool the money, but in reality it's a pool of various tokens, and of course doesn't include real money. Now let us move to yield and yield farming. Many Ether and Bitcoin holders would like to receive the highest returns for holding these cryptocurrencies, so to receive the income by just holding crypto assets passively. But the problem is that it can be difficult for you to search the best possible project for yourself, then do the research, understand its reward mechanisms, and be hopeful that there will be lucrative returns very soon. With yield farming, it's possible to temporarily move your tokens to the most attractive project, and then move them to another project which will provide even better returns. Yield farming also allows linking the projects, so you may lend from one project and contribute to your borrowed capital to another one. Yearn is the most famous yield farming project founded by André Cronier. It was founded on a straightforward mechanism and initially included smart contract that looked for the projects that would provide the best returns and invest the capital as long as it was necessary, and then we would withdraw it to invest somewhere else. Then the mechanism got improved because every time a new investor contacted with the smart contract, it would start another hunt for the best deal, which was the opportunity to move everyone else's coins to the best project. The amount of investors have grown, and that helped Yearn to optimize its techniques and lower aggregate transaction fees. Yearn also created a token pool, the Y pool, and rewarded the investors who provided capital to Y pool with Waifu token. Yearn, of course, is still developing and includes many new projects and initiatives. Now, I have some remarks here. The book doesn't discuss various technical issues about Yearn, which I'd like to hear. For example, what happens to the custody of cryptocurrencies, to their private keys, what the smart contract does to them, how smart contract selects the projects, what happens when the project is unsuccessful, what is the time limit for a project, and so forth. And in general, I'd love to have more detailed description of the project. The book also discusses decentralized exchange Uniswap. It is mentioned that currently crypto exchanges are massively centralized, which on your behalf take the custody of your private keys, and therefore they face security issues, so they can be hacked and crypto may be stolen. Uniswap is a decentralized exchange, and Hayden Adams is its creator. There were various technical issues Uniswap needed to deal with, such as price fluctuation of tokens and aligning the price of tokens that were placed on the decentralized exchange to the market price. It operates with smart contracts and regulates pricing by cleverly designed supply and demand model. And the liquidity providers on Uniswap get their income from the Uniswap transaction fees, so the more transactions are made on Uniswap, the more money is made by liquidity providers. Then we go to Chainlink. It won't be out of ordinary if we say that blockchain is a self-contained system. It is deterministic in the sense that it just records transactions, so it can function properly by just having a limited interaction with the real-world data. and doesn't require the inclusion of external information. But we know that Ethereum and smart contracts arrived and changed the situation. So big blockchain connected to the real world, and it connected in a deeper sense. The integration of blockchain has been growing each day, and it has become necessary to provide the updated data to blockchain, and the task was taken by oracles. The book discusses Chainlink oracles that supply smart contracts with the real world data. Chainlink is founded by Sergey Nazarov, and it is a kind of new product. It's not a protocol nor a smart contract. It just provides trustworthy real world data. As we said, the intensity of the interaction of smart contract with the real world data has been growing, and therefore Chainlink became very important. Like blockchain, Chainlink also has nodes that are called oracles, and so it has the oracle network. The network is decentralized, and each node is connected to one or more external data services to provide the data to smart contracts, and based on that data, smart contracts process transactions. Data can be of every type, such as weather data, price of the good, and so forth. By using various separate oracles, smart contract is able to check the validity of the received data. So if different oracles supply the smart contract with the same type of data and data matches, then the information is reliable. That is called the oracle consensus. Now, oracles can also be meddled and manipulated. So Chainlink secures the working of oracles by public key cryptography. Chainlink has another mechanism for ensuring secure data processing. It assesses the working of nodes, and if they provide the poor data or are unresponsive, they will get a bad feedback and may be forced out of the network completely. Chainlink rewards highly efficient and honest nodes by its governance tokens that ensures the high quality performance. As we have already seen, DeFi investment can be risky, smart contracts can be hacked, and so forth. Therefore, there is an insurance company, Nexus Mutual, that insures the crypto risk. It is itself a DeFi project and insures another DeFi project. For example, it insures the whole DeFi protocol compound, and it insures compound against oracle attacks, governance attacks, and other threats, and now it also covers crypto exchanges. Nexus Mutual also has NXM tokens. Anyone who is willing to assess the risk of a particular product can stake these tokens against their expertise. So if they give the product a positive assessment and claim that its security will not be breached, they will stake their tokens, and they are rewarded if someone buys the insurance for this product. But then they are punished if the violation of product results in the insurance claim which is granted. So the risk assessors are incentivized to correctly analyze the risk with a particular product. Interestingly, Nexus Mutual is a digital cooperative and not a DAO. It has an advisory team which consists of 5 experts and founders who mediate and approve various matters. The NXM token holders have a right to vote out the team members and replace them with the new members. Now let us make final comments. I really like the book because it discusses the most actual and interesting DeFi projects. It first introduces blockchain and smart contracts and only then moves to DeFi, which is a great thing to do. The language of the book is clear and engaging because authors did their research. What really matters is that they provide perspective on decentralized finance and also communicate its crucial aspects quite well. The projects that they analyze are really successful and important, so you will not have much to complain after reading it. Of course, there are some issues. I'd like to have more discussion on the DeFi projects, what they are and how they work, because there are certainly many interesting aspects that the book doesn't touch on. Authors include personal success stories of various DeFi founders, which I think is not that much necessary, so I would have added more information into the DeFi projects instead. The second part of the book becomes a bit less informative, and also the book lacks the strong conclusion that could demonstrate the great future of DeFi. I'd rather have a deeper analysis of DeFi and more speculation on its future. Otherwise, it is a very informative and entertaining book, which certainly will interest you. And make you want to learn more on DeFi, which is achieved by the authors.